You don't need 100 different stocks to build wealth. What you need are a few great businesses, ones that you can keep buying steadily, especially during pullbacks, without second guessing yourself every week. In this video, I'm breaking down 10 Canadian stocks to buy nonstop for the rest of 2025. These aren't trendy plays or penny stocks. These are real companies with strong balance sheets, consistent earnings, and long term relevance. Whether you're just getting started or looking to refine your portfolio, this list includes a healthy mix of defensive dividend payers and high quality compounders, ranked from good to best. If you're serious about investing in Canada, this one's for you. And if you find value in this type of content, tap the like button and subscribe. Over 90% of the viewers are still not subscribed, and it helps the channel grow more than you think. Let's get started. We're kicking things off with TELUS, one of the three major telecoms in Canada. TELUS makes the list not because it's exciting, but because it's dependable. And right now, deeply undervalued. Over the past year, TELUS stock has been hit hard due to rising rates and higher debt loads. But underneath the short-term pressure lies a long-term opportunity. TELUS is aggressively investing in its fiber optic infrastructure, which is critical for future-proofing its network. It's also quietly building a massive digital health business through TELUS Health, one of the largest of its kind in Canada. You're getting a dividend yield near 7% while waiting for the turnaround. For investors looking to lock in reliable income with upside potential, TELUS is an easy stock to buy monthly. Next is Fortis, a defensive powerhouse. If you want one stock that's designed to survive recession, market correction, and rate hikes, this is it. Fortis owns regulated electric and gas utilities across Canada, the US, and the Caribbean. What that means is steady, predictable cash flow. Fortis has increased its dividend for 50 consecutive years, and it expects to keep growing that payout by around 4 to 6% annually. It won't 10x your money, but it will let you compound slowly and safely. And that counts for a lot when markets get choppy. This is the kind of stock you dollar cost average into without overthinking it, especially inside your RRSP and TFSA. Energy can be volatile, but CNQ is built differently. It is one of the largest and most efficient oil producers in North America. Unlike many peers, CNQ has a low decline rate on its assets, meaning they don't need to constantly reinvest just to stay afloat. The company is flush with free cash flow and has committed to shareholder returns. We're talking about a solid base dividend plus special dividends and aggressive buybacks. Even if oil prices dip, CNQ's low-cost structure helps it stay profitable. If you believe energy will still play a major role in the next decade, especially as global demand remains strong, CNQ deserves a spot on your buy list. Dollarama thrives in both good times and bad, and that makes it incredibly valuable. As inflation stretches consumer budgets, more Canadians are turning to dollar stores, and Dollarama is expanding rapidly to meet the demand. But it doesn't stop at Canada. Their investment in Dollar City, which operates in Latin America, gives them international growth potential with strong margins. In 2025, they're targeting more store openings and higher sales per square foot, with minimal competition in their space. Dollarama may not scream tech stock excitement, but in terms of operational excellence, it is one of the most consistent retailers in the country, and a name that deserves a spot on your portfolio. Let's shift to financials with Royal Bank, the biggest and most diversified bank in Canada. When it comes to Canadian banking, Royal Bank is as blue chip as it gets. Retail banking, commercial lending, wealth management, insurance, and capital markets. They do it all. The recent acquisition of HSBC Canada will boost their international footprint and customer base. The dividend is rock solid with a long-term track record of growth. And compared to US banks, Royal Bank tends to operate with more prudent and regulatory discipline. Canadian banks are facing short-term headwinds with interest rates and slow housing activity, but that just makes this a better entry point. Buy it, hold it, and enjoy 3 to 5% dividend while the business compounds. This next one flies under the radar for a lot of retail investors, but it shouldn't. Couche-Tard is a global convenience store operators and gas station chain that owns Circle K and other brands across Canada, the US, and Europe. What makes Couche-Tard special is how quietly and efficiently it operates. Management has executed dozens of acquisitions over the years without overpaying, and the company keeps expanding margins while reducing debt. Even though it's a retail stock, it behaves like a compounder. There's still room for growth in emerging markets through digital transformation, and they have hinted at moving into EV charging as part of their long-term strategy. Underappreciated, but not undervalued for long. Now we're getting into the heavy hitters. Brookfield Asset Management. Brookfield Asset Management is one of the most powerful financial companies in the world, managing over $90 billion in assets across real estate, infrastructure, renewables, and private equity. What makes Brookfield special is its fee-based business model. As money flows into alternative assets, Brookfield gets a cut, and that fee income is consistent and scalable. They're also expanding rapidly in Asia and the Middle East, positioning themselves for future growth. Insiders own significant stake, and they recently spun out of the business to focus purely on asset management, a capital-light, high-margin segment. If you want global exposure with Canadian roots, Brookfield is your gateway. In third place, we have Canadian Pacific Kansas City, or CPKC. This railroad is now the only rail company in North America that connects Canada, the US, and Mexico. That makes it a strategic asset for the future of trade and manufacturing. As more companies shift their supply chains from Asia to Mexico, also known as nearshoring, CP will be the backbone moving goods across the continent. Rail is incredibly hard to replicate, giving CP a wide moat and strong pricing power. The company is already streamlining operations after the merger and is expected to see strong earnings growth over the next few years. If you want a long-term infrastructure play with a real economic leverage, CP is the one to keep buying. At number 2, we have Constellation Software, possibly the best Canadian business that most people still don't fully understand. CSU buys small, vertical software companies around the world and holds them forever. They're incredibly disciplined, only acquiring companies with stable cash flow, loyal customers, and niche markets. Constellation rarely makes headlines, but their results speak volumes. The stock has compounded at more than 30% annually for over a decade, with no hype, no flashy products, and minimal dilution. They have recently launched a new public investment arm too, which adds even more firepower. CSU isn't cheap, but great businesses rarely are. If you want quiet, boring, unstoppable growth, this is your stock. And finally, the number one stock to buy nonstop for the rest of 2025 is none other than Shopify. It is not just Canada's top tech company, it is one of the most important e-commerce platforms in the world. Yes, Shopify went through a major correction after 2021 boom, but that reset was healthy. The company trimmed fat, refocused on its core merchant solutions, and has now returned to strong revenue growth. They're innovating in AI tools, cross-border logistics, payments, and enterprise-level partnerships. And here's the key. Despite the recovery, Shopify still trades far below its all-time highs, meaning long-term investors have a rare opportunity to accumulate at a discount. If you believe in long-term growth of digital commerce, Shopify is a no-brainer. High risk? Sure. High reward? Absolutely. There you have it. 10 Canadian stocks you can buy non-stop for the rest of 2025. Ranked from stable dividend payers to explosive compounders. This list gives you both safety and upside. If you enjoy this breakdown, leave a comment and let me know which one are you buying next. And if you're looking to buy US stocks before the Fed rate cut, check out my last video. Don't forget to like, subscribe, and turn on notifications so you don't miss it. Thanks for watching, and I'll see you in the next one.